Every trading chart you've ever looked at is built on a lie. The candlesticks, the moving averages, the volume profiles, they're all built on time bars, and time bars are one of the worst ways to structure financial data. I'm Jaden, and this is where we break down what the smartest quants actually do with data, the stuff nobody teaches you. Not financial advice, just the math. They don't want you to see. Here is the problem. A 1-minute candle at 9:31 a.m. might contain 1,000 trades. A 1-minute candle at noon might contain 20, but your chart treats them the same. Same width, same importance. The market didn't process the same information in both minutes. You're oversampling the quiet and undersampling the noise. This isn't just academic. Marcos López de Prado, the guy who ran machine learning at the world's largest hedge fund, says time bars are the first mistake most quant researchers make. The data looks clean, the charts look familiar, but the statistical properties are garbage. Serial correlation, heteroscedasticity, fat tails, all because we sample by the clock instead of by the market. The fix is simple. Instead of sampling every minute, sample every 1,000 trades. This is called a tick bar. When the market is busy, you get more bars. When it is quiet, you get fewer. You're now sampling in sync with information arrival, not with the rotation of the Earth. And the statistics back this up. Mandelbrot and Taylor showed in 1967 that returns sampled by transaction count are closer to a normal distribution than returns sampled by time. That matters because most ML algorithms assume your data is approximately normal. If it is not, your model is learning noise. But tick bars have a flaw. One trade can be 10,000 shares and another can be 10 shares. The tick bar treats them equally. Volume bars fix this. You sample every time a fixed number of shares trade, and dollar bars go further. You sample every time a fixed dollar value is exchanged. If a stock doubles in price, you need half the shares to move the same dollar amount. Dollar bars adjust for that automatically. So far, we've gone from time to ticks to volume to dollars. Each one is more honest about what the market is actually doing. But López de Prado doesn't stop there. He asks a deeper question. What if we sample based on when information arrives, not just when trades happen? This is where it gets powerful. Tick imbalance bars, you classify every trade as a buy or a sell. You track the running imbalance. When the imbalance exceeds what you'd expect from random trading, you sample a bar. The idea, when informed traders are in the market, they push order flow to one side. The imbalance is the fingerprint of someone who knows something, and you want to sample those moments, not random clock ticks. The last piece is how you decide when to look. The CUSUM filter tracks cumulative deviations from what you'd expect. Small wiggles ignored, a sustained move in one direction. That triggers a sample. Unlike Bollinger Bands, which fire every time price touches a line, the CUSUM requires a full run, a genuine shift, not noise. You're filtering for the moments that actually matter. Here is the full pipeline. Raw tick data comes in. You structure it into bars, preferably dollar bars or imbalance bars. Then you filter with CUSUM to extract only the meaningful events. What comes out is a clean, statistically well-behaved dataset that an ML algorithm can actually learn from. Most people jump straight to the algorithm. They grab daily candles from Yahoo Finance and throw them into a neural net. López de Prado's argument is that the data structure matters more than the model. Get the bars wrong, and the best algorithm in the world will learn garbage. Get them right, and even a simple model can find real signal. That is chapter 2. Now, you know how it actually works. I'm Jaden. Thanks for watching.